Okay, so now we are moving to the learning objective 11.2. It's about the accounting implications, and we hope that you can make the calculations related to the foreign currency transactions. So it has been explained before in the video, stated that there is indirect exchange rate and also indirect exchange rate, right? So now there is also a situation when there is an import and export transaction, the company itself after this. Okay. So has been explained before that foreign currency transactions is kind of the economic activities denominated in currency other than entities recording currency, right? So for example, before, like, where is the main corporation is in US, so the recording currency of the subsidiary is probably in pound sterling or probably in yen. So there's kind of transaction need to be restated, translate right into the US currency entity. So this transaction includes, so has been shown in the slide, what sort of transaction that involving in the foreign currency transactions. The first one is purchase or sales of goods or services, like import and export, the prices of which are stated in the foreign currency. And also another transaction regarding loans payable or receivable in the foreign currency, and then purchase or sales of foreign currency forward exchange contracts, and purchase or sell of foreign currency unit. Right. So there is a situation when the one party in foreign exchange transaction have to exchange its own currency for another country's currency, right? So 7% will be used as shorthand to refer a foreign currency transaction. Right. So just like I mentioned before, for the financial statement purposes, the transaction denominated in foreign currency have to be translated into the currency of the reporting company uses, right? And there is also a situation when there is an interim, annual, right? So this is going to be reflect changes in exchange rates during the period, right? Then there is a balance sheet date and foreign currency transaction date if it's occurred during the period. So the adjustment restated the foreign currency denominated account to the US dollar equivalent. It will be valued as a balance sheet date, right? So the adjustment in equivalent US dollar values, there is a situation will become up. Probably there is a foreign currency transaction gain or lost for entity when the exchange rate have been changes. Okay. This one, the adjustment will be cause the transaction gain or loss for the entity. Okay. So this is an example. Assume that a US company acquired 5,000 euro from its bank on January 1 for the use of the future purchase from the German companies. The direct exchange rate is 1.20 $1.20, right? Thus the company pays the bank $6,000 for 5,000 euro. So let's have a look at this one. There is US dollar equivalent value. So 5,000 euro is equivalent with the $6,000. How can we get the number? Because the exchange rate, the direct exchange rate is 1.20. So what could be the record for this one? In January 1, since they purchases, right? There is purchases here. And then for the foreign currency unit, we call it in debit 6,000 and gas at 6,000. And there is another situation on July 1st. So the exchange rate is 1,100 dollar, right, for €1. So there is an adjustment that we need to make. Since, sorry, I think it's before 1,200, right? Yeah, it should be 1.20. It should be 1.1, right? So 1.1. Since the book started to 1,200, so I thought it's 102,000 should be, right? So they acquire any euro, it's going to 1,200, and then it's acquired in July 1st. It's become 1,100. So the value it's becoming. So I'm just going to make it a note in here. Can you see it? Okay. So the equivalent dollar before it's value of the 5,000 euro, right, on January 1. So it's 5,000 euro. Sorry, I didn't find this one. So I'm just going to type in euro. And it tops with that. It's becoming 6,000. Right. But on July 1st, the equivalent dollar value of 5,000 euro. So now it's become 5,000 euro times with that. So since it's July, it's becoming 1.1, right? So now it's becoming this one. Right. Okay, so what is happening here? So there is a foreign currency lost. So its amount is 500. Okay. So there is a decrease in the direct exchange rate. It would be reflect the US dollar has been strengthened, right? Okay, so that was situation happen in the if there is any changes. Okay, so if the US company will want to prepare financial statement on July 1, so the entry will be financial foreign currency transaction lost 500, foreign currency units 500. So why there is a loss here? Because this is a result of the foreign currency transaction and it's include period income statement, right? So usually there is an other income or losses. So some accountants use the exchange loss instead of the foreign currency transaction loss, right? So
it's 7 hours.
The foreign currency units account is reported on the balance sheet is value 5,500. Equivalent to the US dollar on that day. Okay. All right. So in the previous example, everyone, so the US company used the US dollar as for the primary currency, right, to perform the financial and operating function. We call it functional currency. So there is several we call it definition, right? So several definition that you have to be understand. Okay. So so that was the first one. So when there is functional currency is a US company, they use the US dollar for the primary currency, right? And also for operating and also for the financial activities. And the US company prepare its financial statement in US dollar. So we call it, so in the US company, they use they prepare financial statement and there is a currency in there we call it reporting currency, right? And other currency that are denominated other than US dollar, so we need to we need to translate it into equivalent US dollar value. That's why we call it that's why there is a situation when the majority of the business transaction cost that less in the local currency, right? So in which they are operating. Okay, so there is a functional currency, reporting currency, and a local currency itself. So where the company is operating. Okay, so they gain or loss of foreign currency transactions, it's substantial, right? So that was kind of the short information related to the foreign currency transaction. So please continue to the next video.